Shopping for an IUL policy? Maybe you've heard all the good stuff. They grow your money risk-free, accessible tax-free, but that is only true if these 5 mistakes are not made. In today's video, we're going to dive into the 5 common mistakes that I see made by agents when designing these policies for clients and what you need to be on the lookout for as a future client. Now, where do I get the credibility to be speaking on this topic? My name is Amanda Ryba. I have spent the last 9 years of my career mastering how to properly structure IUL policies to meet my clients' goals. I've helped over 600 clients. I have trained hundreds of licensed agents all across the country on how to do this correctly. Even until now, the past 3 years, I've been producing content on social media, teaching agents and clients what to be on the lookout for. I'm honestly just sick and tired of this product getting a bad rap because there is poorly trained agents representing it to clients. So today, we're gonna set the record straight. Let's dive in. The very first common mistake I see made is not understanding the client's objective for the policy. It's important to know that there are 3 different ways you can design and structure an IUL. The first one is for life insurance and living benefits. Yes, it is permanent life insurance. Most of the time you can get a living benefit rider added to it, meaning you have access to that death benefit while you are alive for anything that's considered critical, chronic, or terminal. There are some people that open up an IUL just for the permanent life insurance. Now, the second way you can design an IUL is for tax-free retirement, or what we call supplemental income in retirement. In this case, you're looking at getting a little bit more life insurance so that the client has room to increase their premium over time. And the third way you can design an IUL is for what we call immediate access to cash, or the buzzword today is infinite banking, meaning they are going to max fund that policy from the very beginning with the intent to be borrowing money out very quickly. If you, as the agent, do not ask your client what their objective or their goal is for this policy before you set it in force, you could destroy their chances of ever achieving that goal. The second common mistake I see made today with IULs is the insurance agent picking the wrong insurance company. Well, yes, I truly do believe an IUL is an IUL. They all grow and work very similar today. However, there are differences between the type of clientele different companies choose to work with. Some companies are better for clients that are older. Some companies are better if they're younger. Some are better for clients that might be a little bit heavier or fluffier, as I like to call it. Some might be better for clients that smoke. Some companies have product lines specifically designed for cancer survivors, and there are some companies that are fantastic for immediate access to cash, or what we call infinite banking, while others might be better for a tax-free retirement approach to the policy. So it really does matter what the insurance company is that you are selecting to do business with. This is why it's so important that you sit down with an agent that is non-captive, which just basically means they can work with more than one insurance company and they can do the shopping for you and make sure you're getting the absolute best deal. The third and oh-too common mistake I see made with IUL policies is the client is funding the policy at target. What is the target? The target is the number inside the IUL that the client should be overfunding on an annual basis to grow cash value if that's their goal. It is also the number that your agent will get paid a percentage of. The higher the target, the higher the agent's commission, and that target number is controlled by the death benefit. The higher the death benefit, the higher the target. The lower the death benefit, the lower the target. The only reason a client would ever fund their policy at target on an annual basis is if they were designing that policy to be just permanent life insurance and living benefits. If their goal is for that policy to be either tax-free retirement in the future or have immediate access to cash for things like infinite banking, they would never, ever, ever fund the policy at target. They would fund it at over the target premium number. So for example, if you're designing this for tax-free retirement, you do want to leave a little wiggle room in there for the client to increase their premiums in future years, but they don't need a ton of wiggle room. The formula is usually the client's monthly premium times 10 should equal the target. What that's going to do is give you 2 months worth of wiggle room for that client in the first year. In case they need to skip a month of premium or take a month off or whatever the reason is, they can skip up to 2 months and still hit the target premium in the first year. Now, if the client is looking to fund the policy immediately for immediate access to cash like infinite banking, you actually want to be looking at what's called either the 7-pay premium or the guideline annual premium. The 7-pay premium is the most that the client can contribute into the policy in the first 3 to 5 years, depending on their age and a few other factors. And then that number will actually get reduced down to the guideline annual premium in all future years. So if your goal is immediate access to cash, really the number you want to hit in those first couple years is the 7-pay, which is basically the maximum that you can put in per year. Then in future years, that will get reduced down to the guideline annual premium. But you guys, if this is done incorrectly, you could really do some damage to how your client is going to get access to their money. No more funding at Target. The fourth O2 common mistake I see made with IUL policies is selecting only one index for how the cash value will grow. You guys, diversification is key. We hear it all the time when it comes to the stock market. It works the exact same way in your IUL policy. Every insurance company that exists today has more than one index to choose from for how the cash value will grow. In fact, most have somewhere between 5 to 10, maybe even 15 to 20 indexes you can choose from. Some are just traditional indexes like the S&P 500 or the NASDAQ with a cap on the growth. Some might have a spread, meaning you can earn uncapped growth, but the insurance company will take a percentage of the profit. Some have a fee, meaning maybe they charge you 1% per year to be in the index, but you can earn whatever the market does. And then nowadays, what's really popular are what's called low volatility indexes, where these indexes aren't designed to do over really 10% growth. So the insurance companies actually give you a multiplier, or what we call a participation rate on your money. Meaning if that index does 10% and they give you a 240% multiplier or participation rate, you're earning 24% on your money that year, right? That's basically how they work. So please, please, please do not put your clients all in one index. Diversify them. They all grow differently. Give your client the best chance at seeing high cash value growth inside their plan. The fifth very common mistake I see made with IUL policies is both the client and the agent not understanding the loan options. The cool thing when it comes to IULs is that you have the ability to borrow out your money. The loan is what allows you to get to the interest you earn inside that plan tax-free. And there are two different types of loans you can typically do. There is what we call declared, also called standard, or alternative, also called participating loans. Declared loans actually will remove your money from the account. They do allow you to access your interest tax-free, and they do allow you to put the money back into the policy. And most of the time, they're free. If you've ever heard the term zero wash loan, typically what the insurance companies will do is charge you an interest rate for the loan because they have to in order for it to be considered a loan by the IRS, but then they recredit that interest back into your account at the end of the year. We work with some insurance companies, for example, that charge you 6% and then recredit you 6% at the end of the year, essentially making the loan free. The other loan type we have is participating loans. Participating loans are not free because you're not actually removing your money from your account. Instead, the insurance company is taking a look at your cash value and saying, okay, we will give the client up to this amount in a loan from our account, and we will use their account as collateral for the loan. So they might charge you somewhere between maybe 4.5% to 5.5% interest to do this. But what happens is you are actually borrowing money from the insurance company while your money can stay inside your cash value account, growing and earning interest, completely uninterrupted. Now, again, that loan type does charge a fee. So I usually only recommend taking that loan type out if you actually plan to pay that loan off at some point in the future, because that is going to compound and get pretty hefty if you don't. But this is why it's important, because if the client is looking to do things like infinite banking with their policy, they need the variable loans. The declared, the standard loans won't work for that. And not every insurance company offers participating loans. So again, this is why it's important to know the insurance company and the product that you're working with, because again, you could really do some damage to your client's finances if they were expecting this loan type and they don't have access to it. There you have it. Those are the top 5 most commonly made mistakes I see made with IUL policies. And again, my goal is not to be here and bash agents that are on the field. My goal is to partner alongside you and help educate you on how to properly structure and design these plans for your clients. If you are an agent, please study this video and make sure that you are doing this correctly, and please share this with anyone else on your team that needs to learn how to do this. If you are a client, please again study this video and make sure that you know how their policy should be properly structured to meet your goal. So when you receive that quote from your agent, you know what to be on the lookout for. And if you are on the hunt for an agent that knows how to do this and do it correctly, and you live in the United States and you like to work with me or my team, you can just click the link in my bio or in the description below to get access to my calendar where we can have a complimentary client consultation with you. If you like this video, give it a thumbs up and click subscribe because we release a new video every single week and I wouldn't want you to miss it. Looking forward to seeing you back here next week on YouTube.